Matt. I'd love to talk to you about interest rates. Not a new topic. Meanwhile, many investors believe that interest rates in the United States have peaked and that likely we'll see the Fed cutting rates at some point this year. So given all of this, can you share your thoughts on the potential for greater market dispersion amid a more normalized rate environment?
Well, I think, Christina, one of the problems with people forecasting interest rate increases and that being priced into the curve is that the curve doesn't really have a great track record of predicting interest rates. In fact, in my experience, there's typically been two kinds of mistakes. Either interest rates end up going down a lot more than market participants expect because we're in recession, and the reason we're easing dramatically is to cushion the economy. Now, were that scenario to play out, it would probably be very good for defensive assets like gold, and relatively good for defensive sectors like consumer staples, very different from the current leadership of the market today. On the other hand, if we look at the longer term history of interest rates, put some helicopter perspective on, we see from the late 60s to the early 80s, interest rates were drifting upwards with volatility for 20 years. And then from the early 80s to a couple of years ago, drifting lower with cyclical volatility. The fact that we had these multi-decade trends in interest rates means that not only were the forward markets not good predictors of interest rates, but sometimes there were secular forces leading for repetitive surprise in interest rates. And I make this point for the simple reason that interest rates have broken out on the upside from a 40-year downtrend. And so it's quite conceivable, for reasons we don't fully understand yet, that the surprises to interest rates at some point, if we don't get a recession, could be on the upside, whether that's due to the fiscal challenges we face, increased military spending, or changes in sovereign fund accumulation of dollar reserves. Point being that in that scenario, if we do get a reasonable economic growth period, we may not get the interest rate cuts that markets participants expect. And in that scenario, what we may see is companies already pricing recessionary conditions do better. And I'm thinking here of sectors like REITs and real estate, energy, perhaps trucking and logistics, some subsegments of the factory automation equipment area, or even businesses like the consumer staples again that had to deal with all those cost headwinds. In either scenario, the recession scenario with big declines in interest rates, or the kind of grinded out economic growth scenario with interest rates surprising to the upside, the market leadership could change. And this is something that investors need to bear in mind when thinking about lower interest rates.
So speaking of market leadership, the Magnificent Seven, these stocks have surged on their perceived benefit of Gen AI. Meanwhile, the impact of AI extends much further beyond these obvious tech names. Which sectors, in your view, have been or likely will be directly impacted by advances in AI? For instance, I'm thinking about energy for data centers.
So when we think about the impact of AI, we've said consistently that we think the most sustained positive impact is in areas of application-specific AI. And let me sort of dive into that a little bit. When you think of Gen AI, to use your expression, that's really like the logical process of induction. You're basically data mining a huge amount of pieces of information. These chatbots or whatever are scraping the web and looking for patterns and correlations. It's data mining on a vast scale. And the problem with data mining is that sometimes you get what they call in AI hallucinations, credible hallucinations. But we know from science that not all correlation is causation, and not all patterns are supported by theory. And so one of the limitations of the chatbots and the like is that they will sometimes scrape content, find patterns that aren't necessarily corresponding to reality. The reason we like application-specific AI is that it's more deductive in nature. Often companies in given industry verticals are scraping the data themselves first, making sure that the data going into these AI algorithms is clean and well sourced. And then they're asking questions based on theory. So it's more like using AI to accelerate the traditional scientific process. And areas where we're seeing that in our portfolio would be areas such as robotics, where they're using AI for predictive maintenance. We're seeing it in the healthcare industry for scans, whether it's X-rays, CAT scans, MRIs, that are like looking for patterns and managing patient healthcare records. We're seeing it in other areas, such as the military equipment, where they're using AI for precision guidance, but also for threat detection if you've got a fighter jet going through unknown territory. And then finally, one of the lesser known but positive beneficiaries of AI is going to be the energy market, because when you think about all of these server farms that are used to parallel process all these GPUs along with the cloud itself. This is like adding another Germany or another big country to the energy grid, and it's growing at a compound rate. And so energy markets will be beneficiaries of AI. And so if I could sort of summarize it all, AI is kind of a big data mining exercise. And so for us, we get most excited in areas where the market's really not paying a premium and where there is application-specific potential.
Thank you very much for this quick but highly informative update.
Thank you.